everyone. Welcome to another episode of the Eitel Insights podcast. We've got your podcast host, Andy Park, and we've hit the official gloom and doom season of the Vancouver weather market. So we'll see if that translates over to the real estate market today. So again, introducing you to the founder and lead analyst of Eitel Insights. Dane, how are you doing?
Excellent, Andy. How about yourself?
Good. Just trying to survive the weather and trying to survive the downpour that's kind of affected me coming here. But
yeah, it's a little bit of a deluge right now, eh?
Oh, total deluge. But energy's up. Excited for this podcast. So let's dive right in.
Sounds good.
We're gonna dive right into something the Greater Vancouver Real Estate Board had to say. They're looking at this with rose-colored lenses, as they usually are, but we were chatting a little bit before this. They're prognosticating a rebound of 4.1% in 2020 in the detached sales market. Is that correct? And what are your thoughts on that?
Yeah, that's what's kind of been portrayed here through the media, and that seems to be their thoughts. It's, eventually they're going to be right where the market bottoms. However, those that have used the board, let's say, as forecasting analysts, probably haven't done too well over the past few years. They never once said that the market had topped out and that, maybe look out next year, we have a cliff coming or anything like that. That's never been in their jargon, period. Once there was realized losses, they said, okay, this is the amount that's going to be lost. I believe this year they were anticipating a 2% increase. And, we'll throw the chart up on the screen here. There's no 2% increase that is prevalent. Basically, year over year, from November of last year, we're down roughly 7%, over $120,000, right? So definitely didn't show up this year for a 2% growth. And going forward into 2020, as the chart kind of demonstrates here, we are anticipating a break of this 10-year uptrend. The market was hovering right around the lower numbers. We actually see the sale price in November come in at $1,583,000, which is roughly $50,000 higher than where it was the previous month, and kind of coincidentally, again, testing that middle threshold, right? So we see that real instigation of a rebound that we spoke about over a few podcasts ago in the detached market, simply due to the stress test mitigation, right? When the market's down 18%, you're going to see those need-based buyers step in there because it's their first opportunity that they've been able to purchase over the last few years. And that's been really realized here over the last quarter or so. Going forward, we kind of expect them to have almost unloaded their guns, so to speak, and we don't. Again, it was a need-based buyers. There's not the investor mentality or any of that kind of causality to that's prevalent in the purchasing market, right? It's the people that have that need to move up into a bigger property. So once that has kind of come and gone, which we anticipated being realized here over the first quarter of next year, prices again head lower because there's no real antithesis that would break this momentum of it going lower. So there's no need-based buyers that are going to come out of the woodworks. I know that there's people that say, Hong Kong's a factor, and it is, but, once you're getting out of an area that's, let's say, to be kind, is in turmoil, you're not really first thought as to where can I invest my money? It's can I just breathe for a few minutes and get my collective mindset back, right? So that's really not going to be a factor. Not to mention, as we've stated before, investors, foreign or local investors, invest in an asset class that's appreciating in value. Nobody really likes to see them lose 7% or $120,000, and that's why we've gained such attraction here. We do offer the public actionable intelligence through our podcast here and through our covered work that gets featured in the media, like Michael Campbell's Money Talks and so on and so on. So it's offered that kind of actionable intelligence to the tune of $360,000 of savings since our first publication. And, that's a stark, drastic difference than what you've kind of heard here over the last year or so from, let's say, some other analysts. Remember that there was one fellow that said, if you had a 20-year outlook, now is a good time to buy. That was about a year ago or so. Well, how's your portfolio looking? $120,000 in the red. Right. That's not where we want our investors to be. We want you to be purchasing in that lower third of any market so that you can actually see some realized equity into your property rather than lose money in your portfolio, but say, don't worry. In 20 years, you're going to be happy. Right. We'd say, well, okay, hold off. We don't have to have a 20-year outlook, and we'll give you a better return on your investment in a way shorter amount of time. Because not only does that investor that listened to those other analysts they're upside down 120 grand. So that market has to come back just for you to be even, unless you want to keep buying and average your way lower. But that's not really a recipe for success unless you have a real treasure trove of capital available to you. And if you do have that, we can still advise you how to invest it better, right? Yeah. Rather than maybe listening to some optimistic or even some marketing companies have kind of come into the forecasting game. Well, let's say at the very least, they might have an ulterior motive when they're trying to unload condos on you and they're saying now's a good time to invest.
Right.
Maybe, just maybe they might have an ulterior motive, right?
Yeah, and that's an important point. And, from my standpoint, and just to give a fair hearing to the other side, the real estate board, we're not here to disparage them or denigrate them, but we do have to kind of bring to light where their incentives lie, right? I mean, their main purpose is to buoy this market, at least to a point where the real estate agents, they have work to do, and there's enough supply and there's enough demand where they can, sell their properties and buy properties. So I don't think there's any kind of malicious intent behind what they're doing.
I totally agree. And I mean, truthfully, again, to kind of have their back a bit, their job isn't to forecast. The news groups or they put it out there, and then of course it's covered. However, it's just always been inaccurate over the past few years. And they get a pass because, again, that's not their job. That is our job, and we've been very, very accurate at it. So that's where, again, our kind of technical analytics on this real estate market is a brand new way to dive into real estate and to give you actionable intelligence. Going on that, just to kind of, if this is your first time listening, what you saw on the chart here was that threshold, the market cycle. Basically, we're smack dab in the middle at that 1.8 or 583, where the market is projected to go probably first quarter of 2020 is down to that 1.40 threshold. Now, why that's interesting is that basically brings you back to the 2015 levels of sale prices. So over 5 years, you're basically net neutral in your equity.
Yeah.
However, there was a period in time when you basically had $400,000 of equity, brand new equity. What's the odds you didn't go out and buy a BMW, maybe even a yacht, or you chased the market and you bought a couple of condos, maybe as an investment because look how well I've done in real estate. Those chickens are coming home to roost, so to speak, right? So there is some bedlam that will be coming up here in 2020. So when a market sees need-based sellers for really the first time since almost the 90s, it really challenges the notion that this market is bottoming out. I mean, we're going to be into kind of foreclosure talk into 2020. Investors like that, but that isn't a 4% uptick, overnight, right? That actually has to be realized. You see the market go total bottom, and then in 2021, we'll anticipate seeing the overall market be at the bottom, and we'll start to see some liftoff after we break out of these technical features that are pushing us lower longer. After we break the 10-year uptrend to the south and we test the lowest possible parameters, that's when this market is ready to rebound. It's nowhere near that instance right now.
Right. And I think you bring up an important point before is that, if you're an investor, you can average down. And, there is some kind of credence to the argument that, at some point you need to deploy your capital. But at the same time, it's like, why risk that immediate erosion of your capital, right?
Absolutely.
Why not wait it out a few months or a year, and then you'll be able to recoup your investment much more quickly.
And I mean, you could have gone to Vegas a few times and even had a bad day at the roulette wheel, and you lost $120,000. At least you had a real good story, rather than losing $120,000 in a safe investment that Vancouver is, right? So I mean, the 120 grand could be spent elsewhere if you really have that itch to blow $120,000.
Yeah, that's true. Yeah, that's a good comparison. So let's talk about sales figures here. So we've talked a little bit about the prices as we usually do with the detached market. Anything interesting happen in November now that we're kind of at the home stretch of the year?
Yeah. So November basically ran like a scared cat off of the basic kind of news cycle that we seem to be in. We'll throw the chart up on your screen here. And it basically shows, again, right around 950 sales from the previous month in October. Bang, like a scared cat trends lower. Now, that being said, we are seemingly establishing an uptrend, right? Which could break. However, it's also seemingly a V based off of that dramatic downtrend that we're coming out of, right? So we'll see how it goes forward. You're not expecting to see great things in December historically, nor in January. And then it really waits for that spring market where you see a bunch of that new inventory. The one oddity that we do want to show out here is we'll pull up the inventory chart.
Sure, yeah.
That's kind of because the sales in November, there's not too much to talk about. Kind of similarly with the inventory. However, there's a very interesting story that both of these charts kind of don't tell the whole story. We're going to show a days on market chart for the first time to the public here that might be of some interest. So again, we'll just put this the technical chart of the inventory up, and what it shows is basically the first break of this uptrend that was incepted basically in February of 2016. So the total inventory across Greater Vancouver, the detached market, was sub 5,000, right at 4,957. So let's call it 5,000 for easy number's sake. And again, the sales were at 834. So it seems like the inventory is dwindling and the sales can kind of seem to be right around that 950 to 900 range, right? What's odd about that, and what we've kind of prescribed here for people that are wanting to sell, is to take advantage of this stress test mitigation right now before things start going lower and you miss out on this buyer pool that has truly been pent up and waiting for almost 2 years because they were forced to the sidelines. So we've advised people to take advantage of that. No surprise, prices have kind of rebounded, and if you sold, you've done better than you would have over the past year and more than likely over this upcoming next quarter or two. Now, what justifies that is actually in November, there was only 1,100 new listings. There was actually 1,070 new listings. Again, for easy sake, let's say 1,100. So of that 1,100 brand new listings in November, it stands to reason that a majority of those were the ones that were purchased of the 834 purchasers.
Right.
Now that makes sense because these new sellers are more in tune with this new market. Yeah. You know, it's not rosy, it's not going up, we're actually down, and that's become the realization. However, there's that hope and optimism that next year will be better. Well, you know, that's not the real case that we believe. And so those that have listened to it have actually achieved the sale. But you see this real overweight of inventory of people that have been on the market for months. And that's strictly due to the fact that they're not using proper metrics in the list price. Yeah. They're using a comparable market analysis. Well, realtors historically have used that, and that's worked fine in the past, but really all that does is show you the sales from the last few months of similar type properties. Well, those prices are actually evolving lower, right? So you're kind of out to lunch. And if you can't have a real honest conversation or depict a rationale as to why they need to do their price change, why should they price change? You told them a month ago, 2 months ago, they could sell their price at X dollars, and now you're telling them it has to go down 5%. Well, maybe they don't believe you so much because you're still using the exact same metrics that don't really show any difference because there's only 834 sales in the whole market. Right? So, you know, that's kind of that oddity. And again, 834 sales is nowhere near the middle of this threshold throughout the inventory or throughout the sales history. You know, that's sitting right around 1,250, say, just for argument's sake. So we're well below that. So to say that there's a recovery when the inventory is on the rise, given that we're going to be going into the spring market and the summer market, and sales are pretty much kind of range bound, doesn't make sense. So now we'll put up this chart here as to kind of depicting why the new properties are going, but the old ones seem to be sitting longer. So it's the days on market chart. And basically you can see a staunch uptrend after basically a rapid decline. Days on markets from basically 2013, 2012 actually at the peak, we're headed lower from an average of just below 80 days on market to achieve a sale, all the way down to just above 20, right? And that's kind of that misquoted number, to be honest. Everyone says a hot market is when the days on market is sub 20. Actually, the quoted price that is prevalent during when they quote that number is the sales comparative to the actual new monthly listed. And you can
sorry, can you just, or for our listeners,
sure,
and my own, can you repeat that, because that sounded important?
Sure.
Yeah,
so true list to sell ratio is very rarely quoted throughout the media, throughout anybody. True list to sell is the total inventory of the market compared with how many sales there are. That just stands to reason. So 5,000 versus 834. Right. Actually, what the board quotes is the monthly listed properties, so only the 1,100 versus the 834 sales, which shows a really good days on market. Right. It can't be. It just can't. Like, I mean, that's not the whole market, right? So they say, well, this is the month of sales and this is the month of inventory. This is the whole capture of the list to sell ratio. Right. I'm sorry, it's not.
Okay.
You know,
Right.
and
so for the sake of argument, the inventory number is 5,000, and say there were, again, sake of argument, there's 1,000 sales. Realistically, it's 5-1, but if you were actually looking at new listings, it's
the list to sell,
right?
exactly,
right.
would show a lot closer.
Right. So the board will report the 1-1 to make it sound a lot better than it is.
Absolutely.
Right. Okay.
And it's a stable number that they can quote all the time, and it jives, but it doesn't make sense like with a real market. Yeah. It just never does, right? And so that relays to the days on market. So days on market, again, bottomed out here in June of 2016. Stands to reason that's when the market was hot. You couldn't keep a property, multiple offers everywhere. Again, only at 23 days on the market on an average, not the number that was quoted during that time. I can promise you that. So since then, we've actually moved our way up to 57 days on market. Now, how can that be when we have less inventory and higher sales compared to where we were last year?
Right.
Well, that inevitably means that you have houses that just stay on the market for like 6 months, 7 months, 8 months, and they just don't sell. So that's what carries that weight to keep the overall market in a higher days on market rather than a new property that, yes, it's not going to probably sell in a week like it would before, but a listing that takes a month is still achievable if you give a proper price listing at the beginning and you trend out where we're going. Where we're going is lower. Again, I would be advising to list your property if you really want to be selling it sharply here over Christmas. Maybe you'll get a Christmas bid, waiting until spring or summer of next year, you're going to be caught up in the fool's gold rush that we seem to be in. It's going to be better next year. You're going to be caught up with a lot of inventory and still not that many buyers because the buyers that had need base are already in their home. Yeah. They don't have any need. There's no investors. So again, you'll still have that need-based buyer mentality prevalent through the market. However, that pent-up demand of need base has already been exploited by the market or the listing, the properties that are on the market over the past quarter and even over the next month or two. Going 3-4 months out, I wouldn't wager that the prices will be higher than where they're at now. Let's put it that way.
Sounds good. So Dane, if you'll indulge me for a second,
sure,
I'm just going to use a metaphor to explain what you did because I think this is a really important concept and it's the first time we've talked about it. So there's kind of two numbers that we're looking at here. There's the 5,000 listings, active listings in inventory, and then there's 1,000, it's 1,100. It's 1070, but let's just call it 1,100 new listings. And if we use a metaphor here, the 5,000 active listings would be, for example, a jilted. It's a jilted lover, right? So somebody who got broken up with after a long relationship,
hanging on,
and they're hanging on, right? Whereas the 1,100, these people understand what the dating market currently is. They haven't been dating too long, and they've decided to cut their losses earlier rather than later. Right?
Absolutely, and that's the true list to sell ratio, which is rarely quoted, is that jilted lover included, not just the new honeymoon people, right? That's again that's an interesting side note about days the list to sell ratio, which mimics days on market, right? So the days on market is almost in this place can be a misnomer because that's again leading to the overall market rather than newer properties listed sharply are still achieving a sale, and that's really what we're seeing going forward. Those need-based buyers will have bought in, and 2020 will realize a brand new term of need-based sellers, and the need-based sellers will have a real need. So the loss acceleration is there. Now, one thing I do want to point out, we've said it before and we'll say it again, not all markets in Greater Vancouver are created equal, right? So in the detached market, there are a few markets that are closer to their bottom than others. So some, over the next 6 months or 7 months, we could almost even give you a green light to invest in those markets. However, majority of Greater Vancouver still have to realize significant further losses for them to actually bottom. And that's why we'll see the overall Greater Vancouver average still go lower, while some markets don't achieve too much greater percentage losses. They actually just kind of stabilize out because they've already kind of seen that momentum dissipate. But Greater Vancouver overall, still very much lower, longer. And the 4.1 is a cute number. Yeah. I mean, 4% sounds about right, but 4.1? That's cute.
They're way off the mark with that. If they just said 4%, for sure. And with that, I think that wraps it up. Hopefully this was informative to you. If you want to actually understand what's happening in your specific market, because as Dane said, not all markets are created equal, and you want a prognostication and you want some advice on what to do with your specific property, visit eitelinsights.com. Get in touch with Dane and his team. You can email him at dane@eitelinsights.com. And just a quick note on this podcast, we appreciate the growing subscriber base. We appreciate all the love that we're getting. If you enjoyed this podcast, if you found it helpful, give us a thumbs up, give us a subscribe, smash that subscribe button. I know, Dane, you love it when I say that.
Yeah, buddy.
And we'll see you on the next one.